Welcome to Talking Business, your straight-talking guide to dealing with corporate matters. Whether you are a private or public company, an owner-managed business or an entrepreneur, a director, company secretary or in-house counsel, this is the podcast for you. My name is Sophie Brooks and I'm a partner in our corporate team. I was a transactional lawyer for a number of years before becoming a professional support lawyer, which means I'm now responsible for know-how across our corporate team. Hi there everyone, hope you're all well. In today's episode I've got a bit of a mixed bag of cases for you really, covering things like auditors' obligations to shareholders, directors' misconduct and insolvency. But first up we're going to look at a case involving the interpretation of accounting concepts in price adjustment mechanisms. So here the High Court has overturned an expert determination under a share purchase agreement because the expert treated accounting liabilities as assets that increase the purchase price. So the case concerned the sale of an insurance brokerage business. And under the relevant share purchase agreement, the consideration that was payable by the buyer was calculated by reference to completion accounts, pretty common provisions nowadays. In very simplified terms, the purchase price was defined as the purchase consideration plus the amount of the claims provision plus the amount of the deferred fee income. Now, crucially, the definitions of claims provision and deferred fee income both referred to the amount held by the company in relation to. But actually, both of those items were in fact liabilities, not assets. So the claims provision, which was about £350,000, was an accounting provision for potential professional indemnity claims. And then the deferred fee income, which was about £155,000, represented income that had been received in advance but not yet earned. So after completion, there was a dispute between the parties about how those two items should be treated in the price calculation and whether they each represented a real asset for which the buyer was paying extra or whether they were just simply accounting entries. Now, the dispute was referred to an expert under the share purchase agreement, and he concluded that both the claims provision and the deferred fee income should be added to the purchase price. Now, his reasoning here was that the relevant defined terms each used that crucial word held. And he said, well, this is a commonly used accounting term that means a balance appearing on a balance sheet, regardless of whether it was an asset or a liability. So therefore, even if the balance is a liability, it still counts as an amount held. So the result of the expert's decision was that a materially higher purchase price was payable by the buyer. So, perhaps unsurprisingly, the buyer then challenged the expert's determination, and the High Court set it aside. So the court emphasised that although accounting evidence was relevant, the really important starting point was the proper construction of the relevant agreement as a commercial contract. And the expert had exceeded his remit by adopting an interpretation that was inconsistent with the contractual structure and commercial logic of the transaction. So, in particular, the court found that commercially, the buyer couldn't sensibly be paying extra money for a contingent liability, the claims provision, or unearned revenue that would require work to be done, the deferred fee income. No additional amounts should have been added to the purchase price for these items because there were no corresponding assets. And actually, the proper purchase price had to be reduced by those amounts that the expert had added. So the court set aside the expert's determination because it contained manifest errors. That was the basis on which the provisions in the agreement said the court could set aside the expert determination. And in relation to what those manifest errors were, well, they treated negative accounting liabilities as positive additions to price. They ignored the commercial purpose of the price adjustment mechanism, and then adopting an artificial reading of the word held. So, in the contractual context, this could not sensibly mean shown anywhere on the balance sheet, which was basically the approach that the expert had taken, and instead it had to denote something of a positive economic value that the buyer was acquiring. So, an interesting case, we see lots of discussions, let's say, arising out of completion accounts mechanisms. I think possibly because those disputes happen after completion, when, if you like, the deal's been done, the gloves are off, the buyer and the seller don't necessarily need to keep each other on side, so they perhaps feel more inclined to pursue a dispute in relation to the completion accounts. And in this particular case, I think the case highlights that those misalignments between accounting concepts, so that what does held mean in an accounting concept, and using that word just as part of legal drafting, can lead to pretty expensive disputes. Purchase price mechanisms are not purely technical or accounting exercise, and expert determination doesn't permit an expert to substitute accounting logic for contractual meaning. Those provisions are designed to allocate economic risk, and so they have to be drafted and then crucially applied with that principle firmly in mind. So, in the next case, we're back in the High Court again, and the court here confirmed that for a disqualification order to be made under the Company Directors Disqualification Act, the Secretary of State, who's the person that brings proceedings under that Act, does not have to show that the director's misconduct caused the relevant company's insolvency. So, the Act that we're talking about, I'm going to call it the Disqualification Act, it sets out the circumstances in which a court can make an order disqualifying a person from acting as a director of a company. Now, there are several grounds for disqualification under that Act, but the majority of the applications relate to the court's powers under a particular section which requires a court to make a disqualification order against a person where the court is satisfied both that, firstly, the person has been a director of a company which has become insolvent or which has been dissolved without becoming insolvent. And then, secondly, the person's conduct as a director makes them unfit to manage a company. Now, the Act doesn't actually define what we mean by unfitness here, but when making the assessment, the court has to look at various factors listed in the Act, which include the director's responsibility for the causes of insolvency, any breaches of fiduciary duty, and then also the frequency of any misconduct. So the court has to consider the extent of the director's responsibility for the company's failure, but that is actually just one of many factors that have to be taken into consideration. So that's a bit of an explainer about the Disqualification Act. Let's dive into the facts of this case. So it relates to Alexander Greensill, who was a director of Greensill Capital UK Limited and also Greensill Limited. Now, the Secretary of State brought disqualification proceedings against Mr. Greensill in connection with the insolvencies of those two companies. The alleged misconduct included causing transactions that exposed investors to significant losses, dishonest misrepresentations to trade credit insurers, and misleading the company's boards about the status and risks relating to key insurance arrangements. So, Mr. Greensill applied to strike out the disqualification proceedings. He argued that the relevant provisions in the Disqualification Act required the Secretary of State to prove that the alleged misconduct was responsible for the company's becoming insolvent. And because the Secretary of State had not alleged that Mr. Greensill's conduct caused the company's collapse, he argued that therefore that meant the disqualification proceedings were legally flawed. So when it came before the court rejected Mr. Greensill's arguments and dismissed his strikeout application. It held that there was no requirement that the director's alleged misconduct must have caused the company's insolvency. Nothing in the Disqualification Act supported that interpretation, and in particular, insolvency and unfitness were identified as two separate and freestanding preconditions. The fact that proceedings could be brought against a director of a company that had been dissolved without becoming insolvent was also inconsistent with Mr. Greensill's argument, the court said. So the judge also confirmed that whilst responsibility for insolvency is one of the factors a court has to consider when assessing unfitness, it isn't a necessary precondition for bringing or succeeding in a disqualification claim. So that case, I think, reinforces the provisions of the Disqualification Act being a flexible tool designed to protect the public from unfit directors, regardless of whether those directors were, if you like, the direct architects of a company's failure. The decision also confirms that the unfit test is not a tick box exercise, but it involves a broad evaluative assessment of the particular circumstances of the case. So, for directors facing disqualification proceedings, I think the message is pretty clear. Disqualification cannot be avoided simply by proving that the company would have failed anyway due to external factors. Basically, if a director's conduct falls below the required standard, then the fact that a company's insolvency had other causes won't provide a legal shield for the director. And the director's conduct is going to be judged on its own merits, with the court's focus being on conduct and standards rather than outcomes, whether it led to the insolvency. Okay, one more case for you this month. So, finally, back in the High Court again, where the court refused a company's application to amend its statement of claim to assert that the company's auditors had a duty to report suspected fraud directly to individual shareholders. So here, the court held that the proposed amendment had no real prospect of success, reinforcing established authority that an auditor's statutory and common law duties are owed to the company, not to individual shareholders. So, in this case, a company acting by its liquidators brought an action against its former auditors, alleging negligence in relation to audits that they'd carried out between 2012 and 2018. So the background to the claim was that the company's directors had allegedly acted fraudulently in relation to an investment scheme that the company ran, including by diverting funds and misstating cash deposits. So the company, which remember is acting via its liquidators now, claimed that the auditors had been negligent in failing to detect the alleged fraud at an earlier stage, and that if the auditors had acted properly during any of those audit years, then the company would have been put into liquidation at an earlier point, meaning that its losses would have been avoided. So the auditors did admit to various breaches of duty, but they denied that they had caused the claimed losses. This was because the only individuals able to act for the company were the allegedly dishonest directors at the time. So, even if the auditors had reported their suspicions to the company or its board, that wouldn't have prevented the loss because they would have just been reporting it to the people responsible for the fraud. So, to salvage its claim, What the company did via the liquidators was it attempted to amend its pleadings to assert that competent auditors would have promptly reported the directors' alleged fraud directly to individual shareholders, and also that the auditors should have resigned and basically included details of the fraud in their resignation statement. That would then have enabled the shareholders to intervene to protect the company's assets. But when it came before the court refused permission for the company to amend its particulars of claim to plead that duty on the auditors to report directly to individual shareholders. The court held that the proposed amended case had no real prospect of success and that allowing it would be inconsistent with established law and unfairly prejudicial at such a late stage in the relevant proceedings. So, in particular, the court held that neither the Companies Act nor international standards on auditing imposed any duty on an auditor to report suspected fraud directly to shareholders. Nor did the provisions on auditor resignations in the Companies Act establish any route for direct reporting to shareholders. Instead, those particular provisions contemplated any resignation communications being channeled through the company itself and also the Registrar of Companies. And then finally, the court said, well, actually, established case law doesn't support a direct duty to report fraud to individual shareholders. And the leading case confirms that auditors report to shareholders as a collective body and not directly to individual shareholders. So, despite the admitted failings of the auditors, the court held that it was the directors' own dishonesty that was overwhelmingly the most important cause of the company's loss, and so the court reduced the company's damages by 50% for contributory negligence. So, a bit of reassurance there, perhaps, for auditors, because the case confirms that their primary legal obligation is to the company and not to individual shareholders, even where that company's management has acted fraudulently. Whilst auditors have to report appropriately within the statutory framework and obviously comply with regulatory and criminal reporting obligations, they are not required to act as direct whistleblowers to a company's individual shareholders. So there we go, 3 cases for you there this week. Hope they've all been interesting, and I will speak to you again next time. Thank you for listening to Talking Business. To find out more about the series, please visit gatelyplc.com/talkingbusiness. From there, you can subscribe for all updates, meet our speakers, and get more information on all of the topics being discussed.